I wanted to start off with the housing market, and we're seeing mortgage rates, they're increasing, mortgage apps, they're declining a little bit. I wanted to get your take on what the housing market is doing right now. How is it affecting the bubbles in the housing market? I mean, where's the housing market going right now?
Well, the data we have, such as the Case-Shiller Home Price Index and other data, we have to remember that they always lag behind. Especially the Case-Shiller data is a 3-month rolling average with essentially a 1-month lag. So it's looking right now. We're looking at the data of December, January, and February. So in the median price data, we're including data that are closed deals. So we're looking at a historical thing, essentially. We don't have data on what's going on right now today in the market. And what I hear right now today in the market, especially here in San Francisco, is different what the data tell me. But the data tells me that there is a spike in home prices in some of the most expensive markets in the country, and right in this time frame that we're looking at, it may have to do with people trying to lock in the lower mortgage rates while they persisted. So we're looking at January, February, March deals. So the mortgage rates were lower back then than they're now. So prices in most of these markets have gone up substantially year over year, and at the same time that mortgage rates have gone up, and mortgage rates hit a high that we haven't seen since 2011. They have now, as you said, edged down a little bit, but they're volatile, so they're likely to head back up, and they've been zigzagging like this higher since late last year, and they've gained a full percentage point over the past year, so that makes a big difference. I don't think that in terms of mortgage rates hitting the market that we'll see a real difference until we get closer to a 6% mortgage rate. We're close to an average mortgage rate of 5% now. 5% will cause some ripples in the market. But there's still enough buyers out there to maintain this, I think, at 5%. But it gets to be these expensive homes, that home price inflation has been substantial, so it's getting very expensive to finance these homes, and I think that will be a real problem when we get closer to 6% on the mortgage rates.
And when we get closer to 6%, what do you see happening?
Well, it's already an affordability issue. So people have to step down. So when you have a budget of $3,000 a month for mortgage and the mortgage rates go up and the prices go up, you can buy less and less home for that amount of money. So people are doing that. And so they're stepping down their expectations of realizing the dream. At some point, as you go down the ladder, as the population goes down the ladder, there'll be a part that can't buy anymore. So you'll have buyers that drop off, and you have, and so you usually see, there's a mid-range where buyers just sort of, they're migrating down, they're migrating out of the mid-range, they're migrating down, and so the mid-range is showing weakness, and then the lower end, you'll still have demand, but the people that were at the low end of the lower end, they've dropped off. And so you'll see a demand problem. Already now, home sales are not, in terms of volume, are not strong. They're pending home sales. We just got the number yesterday that were down year over year by 2%. That's a trend we have seen now for over a year. So the past 4 months in a row were year-over-year declines. I mean, we had some upticks before then, but it's when you look at the chart, we're now in a declining pattern there in terms of sales volume. We've seen this in individual cities where the numbers have come down. There's still plenty of demand, but it's harder to make deals. And it's a market that's struggling right now, I think, with high prices and rising mortgage rates, and it will continue to struggle until until mortgage rates are to the point where enough people fall off to where we can actually see demand deteriorate to where prices will have to be cut substantially to bring those people back in.
Now, you wrote a while back an article about the housing bubble in all different cities and things like that in Canada and everywhere. I mean, do you think if these rates continually move up, do you think it's going to pop these bubbles?
Well, in Canada, for example, in Toronto, one of the hottest housing markets back then, it has already turned. So home prices are already down from a year ago. In Australia, in Sydney and Melbourne, home prices are down from a year ago. So these are two markets that haven't even seen a downturn or much of a downturn during the financial crisis. They had no correction for 20 or 30 years in terms of the housing market. So these are incredibly inflated housing markets, and the average inflation of the housing market in the United States pales compared to those, even though in San Francisco, we probably can keep up with those pretty easily. But with those kind of price increases, we've had just an insane housing market here. But and so we see that market after market. So Sydney, Melbourne have already turned. Some of the smaller cities in Australia are already turned. Toronto has turned year over year. Vancouver is in the process of doing that. And in the United States, we had a change in the tax law. So, there's a lot of shifting going on now, and that may rearrange some things. And we're the only major country with significantly rising mortgage rates. So people are front running the higher mortgage rates, and we've created a little bit of a flurry of demand because of that. So the timing will be different, but we've seen in London too, in London home prices have turned. So it's just one market at a time.
Does this remind you of when we led up to 2008? I mean, do you see the same thing happening that happened in 2008 where everything just, collapses?
Every financial crisis will eventually lead to a financial crisis somewhere else. So our financial crisis in the United States won't be repeated in the United States. I don't think so. I mean, there have been lessons learned and things have changed, and banks are much better capitalized and not as risky anymore as they were. And so things have changed. I think the next financial crisis, maybe of similar nature, will be in Australia and in Canada. And they've had mortgage fraud there. They've done all the things that we went through in before 2008. So they've had mortgage fraud. They've had incredibly inflated home prices. They've had all kinds of things and now in Australia, they have all the bank investigations going on. And, so I think these markets are ripe for a financial crisis. Now, Australia and Canada are not huge economies. So, Canada is about 1/10 the size in terms of its economy to the United States. It's right there with California, approximately. So it won't have the global impact that a financial crisis in the United States would have. And I don't see a financial crisis in the United States, but there will be one coming up shortly, and it'll be a smaller one. We've always had financial crises. The Asian financial crisis, the tequila crisis in Mexico. There's financial crises everywhere. They come and they go. And when they're involving smaller countries, they're not, they cause asset prices to wobble and to go down in some places, but they don't cause the whole global financial system to collapse as we threatened to do in 2007, 2008. So I don't see the same scenario repeating in the United States, but I do see a financial crisis on the horizon.
Now, the employment numbers came out, and, the unemployment rate has dropped to 3.8%. But what's very odd is, we're at this supposedly full employment right now. And, they keep telling us that everyone has a job and everyone, is doing well, but, people can't afford housing. People are delinquent on their credit cards. The subprime market is getting hit with the automobile market. I mean, why are we seeing credit card delinquencies if we're at, full employment right now at 3.8%?
Yeah, that's an interesting observation. And that's a troubling observation. Back in the good old days of our financial crisis, subprime fell apart when the economy fell apart and people started losing their jobs. Now we have subprime credit cards, not housing, but subprime credit cards and auto loans taking big hits, and the economy is strong. And these people are defaulting not because they lost their jobs. That's the difference this time. These people are defaulting because credit was too easy and they were given too much credit, and it was too expensive. The interest rates were too high on these subprime loans. I mean, these are usury type interest rates that they have to pay. And so now, even though they have jobs, they can no longer make the payments, and they're defaulting on the credit cards and on the auto loans. The lenders that are getting hit with these are lenders that have really become aggressive over the last few years in the subprime space. And this is smaller banks and specialty lenders. Already two specialty lenders in the auto loan sector that specialize in subprime have collapsed about a month ago. The smaller banks are getting hit pretty hard by their subprime credit card customers. The thing is, the big banks have gotten pretty careful. And so they're spending a lot of money advertising for credit card customers because it's a very lucrative business. And they're offering all kinds of perks that the smaller banks can keep up with. And so they pick and choose the customers. And they may choose subprime customers, but only after doing a thorough check, and they pick the best ones. And the subprime customers that can't get a credit card from a big bank, they'll go to the smaller banks, and they don't ask a lot of questions. They just give them the credit card, and they charge 32% interest on it. And for about a year or so, that works out. The way bank accounting works, they're showing a big profit. And then these people have, $10,000 worth of debt on the credit card that with a 32% interest, and they can't even make the interest payment. We've seen a similar trend in the peer-to-peer lending space now, and they have tightened up. So all the smaller specialized lenders that have tried to make a big profit in the subprime space, and which was possible to make a big profit. I mean, it's a very profitable business if you charge 25 or 30% on a loan. I mean, you can make a huge amount of money doing that while the customer is paying. When they default, it turns sour. That's the situation we have now. It's an end of credit cycle phenomenon. We've had years and years of easy credit. We've had greedy companies going after the subprime business with usurious interest rates, and very predictably, this has now turned sour. And we will see some of those smaller banks and specialty lenders collapse. That's the phase we're in right now.
Will that feed into the bigger banks, or did they protect themselves against the smaller banks?
It already has fed into the bigger banks. Bank of America had a loan outstanding to one of the collapsed auto loan subprime lenders. These smaller lenders have to get the funding somewhere, and the larger specialized lenders, they sell off these subprime loans. They package them into asset-backed securities and sell them off. The smaller ones can't really do that. They have them on their books, and they borrow from the banks against their loan book. And when they collapse, the banks are exposed. So, the smaller lenders weren't a big deal for Bank of America, but so Quicken Loans, all of those companies have loans with big banks, and when they collapse, when those specialty lenders collapse, the shadow banks, we call them for a reason. When they collapse, they will draw some blood among the big banks. In the last mortgage crisis, it was the shadow banks that collapsed first, the specialty lenders, not the commercial banks. And I think we've already seen that, the specialty lenders, the shadow banks, are the ones that take the subprime hits right now.
So you think they're going to be leading the way like they did back in '08?
Yeah, but I don't think they will tear down the big banks like they did last time. I think there will be losses among the big banks, but it won't topple the big banks. There's not enough money involved to do that. That's how I see it. It's a different situation. So we may have subprime lenders default on the loans to the banks, and the mortgage-backed securities and the asset-backed securities may perform badly and create losses for the lender, for their investors. But the risks are really spread now. Their investors spread around the globe that carry the risk now, not just a few banks. So I think there will be damage, but it'll be spread. Banks are still incredibly profitable right now with interest rates being as low as they are, and with the Fed paying 1.75% on excess reserves. And there's $9 trillion in excess reserves at the bank, at the central bank, at the Fed. And, the banks have all this revenue coming in. And so it will take a huge amount of losses to topple them. And I don't think among the big banks, I don't think that's in the cards.
Now, since we're on the topic of banks, I just wanted to go out to Europe and their banking system. We see Italian banks. There was a huge problem there. The ECB says they're, just looking at the situation and there's no cause for alarm. Do you think the Italian banks are going to weather the storm, or do you think this is going to get worse?
Well, a few mid-sized Italian banks already collapsed last year, and one of them was bailed out. Two of them were quote unquote resolved. And Europe never cleaned up its banking sector. The United States cleaned up its banking sector after the financial crisis. That's why I'm saying it won't play out the same way here, because there was a lot of cleanup done here, and American banks recapitalized on the backs of savers, by not paying them any interest for 9 years. And banks in Europe, especially in Italy, never dealt with their non-performing loans. So there's almost $1 trillion in non-performing loans in these EU banks. A big part of that sits in Italy. It's still they have a bankruptcy law system that doesn't allow them to deal with defaulted creditors very easily. It takes a long time, if it's even possible at all, to collect on your collateral. So these bad loans just sit on these banks' books, and they don't get written off. And they turn these banks into zombies, and the regulators continue to fail to do something about it. I mean, that's the problem is, if you wrote off all the bad loans, as you should, the banks would be out of capital, so they look at this, say, we should write them off, but we don't have the capital to write them off, so we don't. And so they don't write them off, and that's a loss waiting to be taken. And the European banks are a lot more fragile, and the Italian banks are not that huge. The big bank we're worried about is Deutsche Bank, and it has all kinds of problems. Of course, we don't really know what the banking problems are. A bank keeps all its problems secret, regulate on purpose. You don't want to create a crisis of trust with a bank, because then you get a bank run, and then the bank collapses based on that. So a lot of the issues that we really want to know about are secret. The non-performing loans are being disclosed now piece by piece in some of these banks, but the other issues, derivative issues and that kind of things, we don't know. We don't know what the problems are. And we won't find out until a bank collapses and somebody sorts through the debris and finds out what's left. And we've seen them with Italian and Spanish banks that collapsed, that there really isn't that much left at the end.
So the credit rating agencies, with Deutsche Bank, for instance, they lowered their credit rating. Now, since they've done this, is this going to have an effect on Deutsche Bank, and is this going to lead into other European banks since their credit rating has been lowered?
Well, in theory, it would make the cost of funding more expensive. So if a credit rating gets lowered, bond investors would ask for a higher return to compensate for the risk. In practice, that's not necessarily the case, especially when you have a central bank that's completely manipulating the bond market. So European companies can still fund themselves at a very low rate in the bond market. Now, Deutsche Bank has some contingent convertible bonds outstanding that it sold after the financial crisis to rebuild its Tier 1 capital. These are bonds that are designed to be bailed in. They don't mature. So unlike other bonds, there's no maturity date. They're perpetual bonds, and they have a fairly high coupon because there's big risk involved. So when the capital threshold drops below a certain rate, the bank stops paying that coupon, and that's not considered a default. That's just part of the deal. And when the bank gets in trouble, those are the first bonds that get bailed in, before anything else happens. While the bank is still upright, those bonds can be bailed in, can be converted to equity, or that's why they're contingent convertible bonds, or they can just be canceled. Now, these are pretty risky bonds, and those so-called CoCo bonds, they plunged yesterday, and they're now down 15%. From earlier this year, and they plunged during the last crisis in 2016. This is an indication of where the bond market thinks the bail-in risks are for those investors. What are the risks that the bank will get in trouble enough to where they bail in those CoCo bonds? And and then there is now a significant risk perceived in that respect. And, the downgrade by S&P today doesn't help at all in this respect. These are bonds that are considered, when the Deutsche Bank sold those bonds, they're considered part of Tier 1 capital because they can be converted to capital and to shares, or can be canceled. So they're very important. And there were a way for Deutsche Bank to raise its capital, not just its cash level, but its capital. Other bonds, when you sell bonds, it just raises your cash level, but it doesn't do anything for your capital because it's just a liability. And so these bonds are very crucial to Deutsche Bank. And and if it needs to build capital in the future, it will need to sell more of those, but they're getting more expensive. So yesterday it was paying a yield of over 7% on those bonds, and which is pretty high in an environment where zero interest rates still prevail. So it gets more expensive for Deutsche Bank to do business. Depositors still lend Deutsche Bank money at no interest whatsoever, so it won't run out of that funding unless depositors get cold feet and they pull out, which it's not happening, but when that starts, when Deutsche Bank gets a bank run, then the German government will step in and bail it out. I mean, they will not allow Deutsche Bank to collapse. It's too big. It will just really tear up the German economy, and no matter what the EU rules are, it will bail out Deutsche Bank. If it does that, my prediction is that shareholders will probably lose much or all of their stake in the government may take a huge stake in Deutsche Bank, which will automatically dilute the existing shareholders to next to nothing, especially when that happens at a low share price. And CoCo bondholders will probably be bailed in, and so they'll approach it that way. They'll bail out Deutsche Bank, but they'll do it at an expense to some stakeholders, but not to depositors and not to senior bondholders.
So what about their derivative book? The credit rating was lowered, and, if things continue on the way they're going, what happens with the derivatives? Because aren't those connected to many other banking systems?
Yeah, and we don't know anything about the derivatives book. There's just a few superficial numbers that they report, and it's huge, but there's the huge part is the notional exposure, and it's not that crucial. So it is really hard to speculate on what that derivative book looks like and what kind of damage that could sustain with it. And that's why a commercial bank should never be involved with derivatives, because it's just it's too much risk. And if it's an investment bank, you can let it go, and if there's no commercial banks involved. But if it's a commercial bank of that size, you can't just let it blow up, because it's a commercial bank is like the electricity grid. It has a utility function. It's used for transactions, for payroll, for everything, So this has to the utility function of a commercial bank has to be maintained, or else the real economy comes to a halt, because you can't make payroll anymore, and you can't get access to your money in your accounts, and you can't pay for things that you bought. And so at the same time, the risky stuff that like derivatives, they should be rolled off to some other bank. And we had that under Glass-Steagall in the United States. They never had that in Europe, and they're not going to. And so those things are now mingled. And we have really, as outsiders, we do not know what risks Deutsche Bank has on its book, in its derivative book. We know it's big, but we don't know what's in it. So. It's counterparties are other banks, and if something blows up, and it might not be Deutsche Bank's fault, that derivative problem may get triggered somewhere else, and Deutsche Bank gets pulled into it. I mean, this is the problem all banks have; they're all linked with this, and some of those derivatives are perfectly harmless, and others are not. So it's just a great unknown.
I just wanted to get your take on how bad this could get if the German government has to come in and bail out the bank. What effect would it have on the global economy with other banks? Like, what would happen if Deutsche Bank starts to really, it's failing now, but really fail?
If they do it well and don't cause panic in the real economy, I don't think it would be a huge issue in terms of the real economy. And markets, would react. There would be a violent reaction in the markets. But in terms of the real economy, I don't think it would lock up. Now, during the financial crisis, we had Hank Paulson stand up in front of Congress and say, who was really exposed to Goldman Sachs and saw his entire wealth hang on a thread, and he said, look, the world's collapsing, you've got to give me unlimited authority to bail out all our banks. And that was a public statement, and that really, really spooked the participants in the real economy. In that moment, everybody stopped the orders. The supply chain came to a halt. People stopped buying cars. And when they heard that the world's coming to an end, it really impacted, it transferred a financial crisis to the real economy. Just that one statement. When the stock market blew up under Ronald Reagan in 1987, he sort of shrugged and said, well, these things happen, it's fine, and the real economy had a recession and went on, and this wasn't a big deal, during the financial crisis, the real economy was drawn in by the way they handled the bank bailouts. If they learned a lesson from that, and if Germany doesn't go that route, if they just say, well, okay, these things happen, there are going to be some losers in terms of stockholders and bondholders, but overall, this is just one of the things. And I think the real economy can get through this without a major problem. And there may be a recession in some. We're going to get a recession anyway. That's going to happen. But the question is, when Deutsche Bank needs a bailout, and we'll get